is going on, everybody? Welcome back to Finance with Parks. In today's video, we are going to summarize the stock market for 2021. We're going to focus on the top 500 companies in the US, or the S&P 500, how it's performed, some of the individual drivers, and just an overall review. Let's get into it. Welcome back to the channel. If you're new here, please consider subscribing. We talk all things personal finance. Today we're reviewing 2021. The stock market was incredible this year, and let's jump right into some of the returns. All right, so as many of you know, one of my favorite investments is the Vanguard S&P 500 ETF, right? Ticker symbol VOO. The reason I like this is because it includes all the top 500 US companies, and it's just one button press to diversify my investments, and then I don't have to go buying single stocks to make up a portfolio. It's already done for you. So let's see how that returned in 2021. Well, first things first, if you scroll down here, the 1 year, 27.87%. That's incredible. I mean, a lot of the times you hear when you're investing in the stock market, you're hoping for a return of 7 to 9% is kind of the historical going rate, right? 28% this year. Now, that does include really what a correction we saw in 2020, right? When the coronavirus first started, stocks really plummeted hard. But ever since then, they've just been on such a steady climb upwards. If you look at even the 3-year return, 20%, north of 20% if you had the VOO. Really good numbers there. Let's look at some of the individual companies that drove that. So now let's be clear, right? I don't recommend investing in these single stocks, and you will see returns greater than 27% because there had to be higher drivers, right? And there's going to be some losers that you'll see as well. But the reason that I like the index fund is because it's really hard to pick these individual companies that knocked it out of the park without, having a potential downside. Picking some of the companies that did not do very well this year. We'll see some of those that returned, negative percentages when the whole market was up 27%. So 27, 28%. So keep in mind, if you did not meet that threshold this year, you lost to the market. You underperformed. And so, maybe you had some great stocks that did 20%, which are phenomenal returns. But at the end of the day, if you didn't hit 27, 28%, you would have been better off in just an index fund. So just want to say that right off the bat, which is why it's always my number one recommendation. Okay, but let's look at some of the individual stock drivers this year that did very well. The first two, Devon Energy Corporation or Devon Energy Corporation and Marathon Oil Corporation, DVN and MRO. Both oil-related, oil and gas, right? And with oil prices so high right now, it's painful at the gas pump, right? But it's great for these companies that are, providing that sort of business to everyone. And you can see that reflected in the returns here, 176% and 145%. That means if you would have invested $100 into these two at the beginning of the year, you would have more than doubled that $100. So you would have been up to like $276 on the Devon side or Devon side. All right, the next couple, let's go down the list here. We'll just highlight some major ones. I like doing this at the end of the year because it keeps me kind of in tune with the market, right? And what are the drivers? Why did we return 28% in the index fund? So you got Fortinet and Moderna. Moderna is probably the most popular. That and Pfizer were one of the two most probably searched companies this year. Moderna at 141% from the start of the year. It's kind of a no-brainer, right? Vaccines have been huge for them. Now, Pfizer is on this list. It did return a positive, but Moderna saw a much better return because they were a little bit of a smaller company at the start of the year. So there was more room for growth associated with the vaccine than there was for Pfizer. So huge one for them. Ford was also up here, 133%. Now you notice Tesla is not in the top 10, and Tesla is one of those car companies that's kind of the golden child of the stock market. And it still had really good returns this year. But Ford is a very well-established company, right? So to see 133% returns is unbelievable for a company of that size and that stature. And really one of the big drivers was, well, right now, used cars, new cars are super expensive, right? Because of the demand and supply. But also the biggest driver here was Ford is going towards electric vehicles. They've come out with an F-150 Lightning version, also a Ford Mustang electric version. So the stock investors responded really well to that because a lot of people believe that the electric vehicle market is going to be the future, right? And that's why Tesla is priced so high. So people really responded well to Ford's move there. 133%. So you can see NVIDIA is a chip maker. Think like processing power. They started with actually Xboxes and PlayStations and have evolved from there. A really great year for them. And that kind of rounds out like the big names in the top 10, right? Not super familiar with the next couple. Okay, so we'll scroll down here and let's show you the cutoff really where you would have a loss to the market. So you can see really great returns all the way up here. So about 230-ish down, you're starting to flirt with companies that if you would have bought them individually would not have returned as much of the index fund would have. And so there are a lot of big names that you're about to see below this 230 threshold. A couple of them are surprising that we'll talk about. So if we flip back here, one I want to highlight, Berkshire Hathaway. So this is a big one. This is Warren Buffett's company, right? They were only at 29%, so pretty much in line with the market. Still, definitely nothing to complain about. 30% is incredible. But down here a little bit lower than I'm sure people would have hoped. All right, so let's keep going, and we'll just highlight some big names here. Northrop Grumman, so defense, they had a good year, 26% up. We'll keep going. There's Chipotle up 26% this year. McDonald's. Now, McDonald's 24%, right? That actually would have underperformed the VOO. So if you held McDonald's, still a good year, but underperformed there. Let's skip down to the bottom because I think that's where it gets the most interesting. You never want to see red when you're talking about stock market returns. Let's look at the worst one. So Penn, the National Gaming, believe this is associated with Barstool, down 41% this year. So if you compare that with we'll make the math easy, right? 30% positive in the S&P 500 compared to a 40% negative, almost a 70% swing if you would have invested in Penn this year. Another one that stands out here as far as a big name goes is casinos or Las Vegas Sands. Obviously, COVID had a huge impact there. Activision, the gaming brand, they were down big time as they got lawsuits and just a really poor work environment has come out against them. So that really impacted their stock negatively. If you keep going here, you can see Twitter and PayPal, two really big names that had a really tough 2021. Walt Disney is down here at negative 14%. Disney, especially in LA, right? Disneyland was closed for a long time. There are mask restrictions. There are capacity restrictions. Florida, as most of y'all know, has just been full-blown open. I think it still affected Disneyland somewhat, or Disney World, I mean. But definitely Disneyland in LA was hit hard from a COVID perspective. So that stock's down 14%. There's also some things with Disney Plus, the streaming service Disney came out with. That was the carrier of the stock price for an extended period of time. And I think the expectations have started to slow down there as well. And then keep scrolling here. Don't really see any more worth highlighting. I guess another one, Lockheed Martin. Lockheed's one of the biggest drivers from a defense perspective. Defense has been in the news a lot lately because of the new defense budget that was signed for 2022. I think it's $760 billion. Somewhere around that number, which is substantial. But Lockheed did have a tough year from a defense perspective. And you compare that to Northrop that we highlighted earlier in the 25 percentile. I mean, that's a really significant difference for two companies that are kind of driven by, similar environments, right? They're both defense related. So to see that difference, it was pretty surprising to me. Then probably the biggest name that we missed, but it's right there, Walmart. Walmart was actually down almost 1% this year, which surprises me because, it seems like Walmart has been doing well. I know Amazon is the poster child of the future, shopping online and things like that, and people think brick and mortar stores are going away. But Walmart is such a staple. Walmart and Target both, I think, really aren't going anywhere. So that one does surprise me that it was down almost 1% this year. All right, so that's all we had in the video. Hopefully you enjoyed that quick summary. One thing I suggest if you're trying to familiarize yourself with the stock market is pick out a couple of these companies on this list that are a part of the S&P 500 and listen to their earnings call. It's a great way to try to understand how those companies make money. You can just search up, like Q3 earnings call Amazon, and it should take you to their investor relations page, and you can go through and listen to the CEOs and the CFOs talk about their business, how they performed over the quarter. Look at some of their financials. It'll take you from their top level sales to their profit numbers to their cash. And it just helps familiarize yourself with what they do and how they make money. So hopefully you'll have a great, had a great 2021, 28%. I mean, S&P 500, awesome returns. Hopefully we can see that again in 2022, but that is to be seen, and there is definitely some risk out there. But if you enjoyed this video, if you could smash that like button and subscribe to the channel, we'd greatly appreciate it. Thanks again for watching, and we'll see you in 2022. See ya.